Of another week, and I've got to say, considering there hasn't been a whole lot on the macro calendar, that certainly feels very tiring. And I think maybe just the waiting around for firstly that Nvidia result, and then the jobless claims out last night as well. Two of the most important releases of all time, as has been portrayed in some markets. But I've got to say that when you look at what's coming up next week, they're going to probably pale in comparison when it comes to broader financial markets. Just to kick off with, I want to go and have a quick look at what's been going on with the US economy. And I'll feed that through when it comes to rate pricing for the Fed and also some other things when it comes to the US dollar and the like. Because earlier this month, the markets are getting really, really uppity about the US economy rolling over hard, a recession's imminent and the like. But I've got to say, since that non-farm payrolls report on July that was released at the start of the month, the data flow has been considerably better. This here is the City Economic Surprise Index for the US. So basically an aggregate look at all the incoming economic data and then measuring it against what the consensus forecast looks for. So it's still negative at this point in time. However, what you can see just more recently is that it's actually started to improve. So the magnitude of downside misses in the US economy are starting to go and ease at this point in time. So I'm starting to wonder whether we've got two downbeat on the US. And you go and look at some of the data that came out last night. Initial jobless claims, again, pretty solid. Big upward revision to Q2 GDP. Big increase coming through in consumption. And I'm looking at the details and I'm looking at how much is priced in to the Fed funds curve and the like. And I'm just starting to question, well, maybe potentially the US is not as weak as what we thought. Maybe we're not going to go and have to go and need so many rate cuts that are priced in. And maybe the US dollar, the big unwind that we've seen recently, has potentially overshot a little bit. Just to go and reinforce that point, this next chart is the same thing. So this is the Cities Again Economic Surprise Index, but it's the US version less the European Union version. And what it's showing right now, the fact that it's sitting in positive territory right there, that's telling me and telling you that on a net basis, the US economy on a surprise basis is faring better right now than the likes of the euro, which begs the question again. We're seeing the euro's had a very strong run up until the last few days, but maybe that's more about narrative and not actually what's reflecting when it comes to the hard data. And so I've started to question whether some of these moves we're seeing in currency markets in particular, and maybe some of the moves we're starting to see the rotation out of those loftier growth names in the tech space and into more cyclical parts of the equity markets and commodities, etc., might have a little bit more legs to go as well. I'm also going to have a quick look now at what's been coming up on the calendar tonight. So, of course, I mentioned the GDP and also the initial jobless claims data. Today is going to be much more important. And you can see here coming up, not to discount the importance of the European Union inflation flash rate that will come out, but we saw a lot of the regional, a lot of the national ones came out yesterday, including Germany and Spain. And both of those came in a little bit under expectations. So just the way that it maps, it's very rare to go and see a big surprise when it comes to this figure. So I'm not sure it's going to be the market mover that we expect. And certainly when it comes to unemployment, it too seems to be very stable in the European Union. So again, I'm not sure it's going to go and deliver much bang for your buck when it comes to market volatility. When you can see here, when it comes to tonight, now for a long period of time, we as traders and investors have been programmed to care about this core PCE deflator. We know it's the Fed's preferred inflation measure. But right now, what we're looking at is that the game has changed. Jerome Powell has made it very clear that the focus is now on labour market outcomes. And so good has the mapping techniques become of economists who are tracking the CPI and the PPI that they can go and feed it into their models. And it's very rare for this core PCE deflator to go and deviate too far from expectations. So I'll be pretty surprised if we get anything that's really like more than a tenth away from expectations when it comes to that reading. So to me, that's not the one to focus on anymore. Later on tonight, I'm far more interested in what's happening when it comes to income. So the fuel to go and potentially continue this strength in our consumption that we've seen recently. And you can see here, personal consumption expected to rise 0.5%. As a growth unit and to go and power the US economy, which is predominantly driven by consumption, we need to care about what's going on with the spending side of the economy. And we saw that retail sales were up 1% month on month in July. So not looking for quite a stronger outcome when it comes to across the entire gambit, but still 0.5 month on month would be a very, very strong outcome. So to me tonight, it's far more important to start looking at what's going on with incomes and spending than it is the PCE deflator. So just keep that in mind for those who are trading around that event later on tonight. When I'm starting to look at what's coming up and I look at where the market's priced right now, I might as well kick off and have a look at Fed pricing when it comes to rate cuts in 2024. I'll go and get that up on your screen right now. And you can see here, this is so what the markets are anticipating in terms of the magnitude of Fed cuts over the remainder of 2024. And what you can see here, we're still looking at over 100 basis points worth of cuts. So that implies roughly a 50, a 25, a 25, maybe two 50s back to back and then a hold. But that's still a lot considering we've only got 3 meetings remaining this year. Now, you can see that some of the data that's looking okay at the moment. You start questioning, well, are we going to go and see easing of that magnitude? Well, maybe not. But as I get to it towards the end here in the Q&A section, there's some grounds to go and see that some signs of weakening that's coming through in the US labour market, which does go and give the Fed the impetus to go and cut quite hard if it's necessary. Looking a bit further out, this is pricing when it comes to the Fed over the next 12 months or so, around about 200 basis points. Hasn't changed a lot over the past week. That still implies a cut at every meeting. Which to me still is that borderline between soft and hard landing. If we start to see it get any more than 200 basis points, it implies we're going to have to do big cuts coming through, supersized cuts on occasion. And in that kind of environment, you don't typically see things perform well. It's generally a sign the economy is performing very, very poorly. So at this stage, we're still okay. And that probably explains why we're seeing so much of the strength and resilience in those cyclical plays we've seen over the past week or so. I thought it'd be really useful as well as to have a quick look at what's going on in Europe, mentioning those undershoots when it came to the Spanish and German inflation prints out overnight. This is looking year ahead pricing, and you can see at the moment it's still pretty punchy. 137.5 basis points, not quite at the levels we saw early in the month when the markets were panicking about the carry trade unwind involving the yen, but still. It's quite a lot. And whilst the euro is not typically a currency that's driven predominantly by interest rate differentials, just the fact that we're seeing this start to go and build again suggests that maybe some of that upward shift we're seeing in the euro might have seen its best days. And we'll have a look at some of the technical setups for euro and these other currencies later on in the webinar. Well, going back to the economic calendar, if you thought that this week was pretty important, well, I can tell you next week's going to be epic. And I'm hoping to get a lot of rest this weekend because I think we're all going to need it. Now, it starts off slow. We've got Labor Day in the States and in Canada. Lots of sort of second tier releases. And I don't want to discount the importance of some of these to some people. But realistically, from a trader's perspective, is it going to really meaningfully move the dial when it comes to markets? Well, I'd probably question no. So you can see in Australia, we've got a whole bunch of job ads data, building permits, very volatile at the best of times. The Caixin manufacturing PMI, we've got the official PMIs out this weekend. I suggest that maybe it's going to get a few more eyeballs and also the services reading than the official numbers. So keep a close eye on that. That potentially could go and spill over into some of the other Asian markets in particular. Realistically though, as the week progresses, it becomes more important in the data flow. And all the times you can see on your screen here in the dates are for Sydney, Australian Eastern Standard Time. And the first real big event comes up on Wednesday, or Tuesday in the States, but very early in the morning, Wednesday our time. And ISM manufacturing. Now, let's not beat around the bush. Manufacturing makes up just over 10% of the US economy, give or take, depending on when we go and do a snapshot of it. It's not a huge part. You could probably argue it's a high beta play on the overall activity, so more sensitivity to changes in demand and supply. But needless to say, the markets have been really twitchy around this particular release for quite a few months now because it's been very weak. So to me, that's the first one you've really got to pay attention to. If we see another weak outcome, those recession fears that really gripped markets back about a month or so ago are likely to flare again. Now, moving further on, you can see here, Australia has its Q2 GDP figures that are likely to come out. At this point, it looks like net exports will go provide a pretty chunky increase coming through. So more or less, we're going to have a very weak outcome in real terms, probably around about 0.2 or 0.3 for the quarter. And that's still going to be going backwards in per capita terms. It's not likely to go and move the Aussie dollar. It's probably not likely to go and move the ASX 200 either, in my opinion. It's more so the nuances within that data. I want to be looking a lot at the productivity side of it as well, because we know the RBA is still very attentive to inflationary forces. And so that's to go and keep a close eye on that. That and potentially household savings ratio as well, which we know can be dipped into to go and fuel spending on occasion. Again, Kaijin Services, as we see here, a lot of the S&P Global PMIs, the final readings, we've already seen the flash estimates, so I really don't expect to see anything too meaningful in terms of market impact. And then we get to Thursday, and then it really starts to ramp up, because you can see here that JOLTS, job openings, a margin of error in this particular release is so wide you could drive one of those Ram trucks through. It's legitimately so wild, and to me, it doesn't really give a really strong signal. But the markets are going to react to it because it's the first meaningful piece of economic data we're going to have on the labour market, knowing that Jerome Powell has made us focus on that particular area very, very closely following his speech last week. In particular, what I'd pay really close attention to is the quits ratio. People don't tend to quit their jobs unless they know they've got one to go to. So that to me is probably going to be one of the things to keep a close eye on, to see whether there's any pullback in that. That would be a sign that there's some concerns starting to emerge in the US labour market. But then when you look further through, you can see here, ADP employment used to be wild, used to be really, really inaccurate relative to what we saw with payrolls. But now we know that payrolls have been pretty inaccurate as well over the past year, and potentially it's still going to be so until we go and get revisions coming through there. So to me, ADP employment is now fair game. It could actually be a pretty decent indicator relative to what payrolls is going to sign. So don't discount the importance of this one, looking for 150,000. Again, jobless claims data for the weekly basis, the near-term thing you'll be able to go and find when it comes to the real-time estimate for what's going on in the labour market. So you can't discount the importance of that. Non-farm productivity and unit labour costs, that feeds through to the inflation side of the equation. Again, it used to be more important than what it is right now. But then we have ISM services. Now, relative to manufacturing, this is more than 80% of the US economy. And so this is the one to watch. And you see here, last time, 51.5 or so is what's expected. 51.4 was last time. That's moderate growth. If it was to go and turn south and go well below 50, that's a recessionary warning, and that would go and get markets very, very concerned about that particular outcome. As long as that holds up though and still presents that resilience in the US economy, that's pretty important. Needless to say, there's an employment sub-index in that reading. Keep a very close eye on that one as well. And then we keep moving along here. You can see that gets the big bopper of all. Jobless claims feeds into non-farm payrolls. Now, non-farm payrolls, we know that the number is rubbery. We know that we can't be trusted. And I know that the markets are still going to be, the initial reaction will be off that particular number. I can't go and change that, but that's what's going to happen. So non-farm payrolls, the figure 163,000 is expected. There'll be a whole bunch of whisper numbers. There'll be people trying to recalibrate what the real number will be to go and account for changes when it comes to the business life cycle that's plugged into the other BLS models. But to me, just to reinforce, the most important thing you need to be focusing on is the unemployment rate. That's what the Fed is looking at. That's what the Fed's forecast is centered around. You can see here, after an increase to 4.3% in July, decline back to 4.2% is actually expected on this occasion. Keep a close eye on participation, because that will go and augment what happens with the unemployment rate. And I'll get to this a bit later on in the webinar as well, but the U6 unemployment rate is, to me, equally as informative as the unemployment rate as to what's going on in the US labour market, measuring the number of people out there who want to work full time but can't go and get the numbers of hours that they're looking to go and work. Just really quickly as well, there's Japan cash earnings as well at some point. Let me go and double check this here. Yeah, you can see here that comes out Thursday in Asia. That's pretty important when it comes to the Bank of Japan. We know that very attentive to what's going on with wage pressures at this point in time, and hoping that feeds into a sustained a lift in consumption and inflationary pressures. Just really quickly, you can see here, this is a 1 year Japanese OIS. So this is basically the market's assessment as to where the overnight interest rate will average in Japan over the next 12 months. You can see around about 32 basis points, I should say. Now, to go and translate that back out, to back it out to go and what it means is to looking 1 year ahead, markets have overnight interest rates in Japan sitting around about 0.545%. So around about 20 basis points more of tightening being priced in. One thing I want to go look at as well, I've just written about it as well, if you want to go look to our research and analysis page, is what's been happening when it comes to dollar Chinese yuan. So we know that it's very, very influential in terms of monetary payments around the world. It's growing in its stature as being used in a variety of transactions. And to me, there's been a really interesting move that's come through over the course of this week. Let me go and just tee up the correct chart here, and I'll just explain why. So what we're looking at right here is dollar yuan, and you can see here, this is this big bearish engulfing candle. You can see that happened on Thursday, and that's despite a rebound in the US dollar that we saw during the session. And look where that's actually gone and left the price. You can see here, I can see actually this morning, we've actually gone and traded at the weakest level back since June of last year. So that's implying the Chinese yuan is actually strengthening against the greenback, which is a little bit at odds with what we're seeing with other major currencies over the course of this week. And if we were to see this level go here, then there's not really a lot to go and speak of on the charts until we get back to around about 7.01265. So that's a decent move down if we break here. When you look at things like RSI 14 and MACD, all again looking pretty decent at this point in time. So not really giving any sign that there's going to be a turning point at this. So keep a close eye on this particular level. If that goes and it goes meaningfully lower here, then it's going to have ramifications and positive ramifications for the likes of the Aussie and the Kiwi. Here's the dollar yuan top pane, and you can see here has been very, very highly correlated with moves in 2-year yield spreads between the US and China, US 2-year yields, US 10-year yields, but just recently started to go and see that correlation weaken a little bit. But I don't know exactly what's going on there. I'd try to go and find any reason for that. Maybe it's some optimism about the global economy or the like, but whatever it is, it's important when it comes to the Kiwi, the Aussie, and EM, FX in particular. You can see here the inverse correlation with the Kiwi at minus 0.82 has been strengthening over the past month. Same to at minus 0.78 with the Aussie dollar. So if we were to see dollar yuan start to go and really motor lower, there's every likelihood that we'll go and see Aussie US and Kiwi US start to go and push higher beyond the levels that we've already seen. So keep a close eye on that as well. Let's have a quick look at what's going on with the US dollar index, because at this point in time, really important. We've seen a big sell-off, and looking at where rates pricing is right now, still looks fairly rich considering where we're seeing the incoming data flow of late. And when you look at the chart, it's putting a bottom. Whether it's going to go and be a sustained rebound right now is questionable. You can see here RSI 14 downtrend in that. The bearish momentum has broken. You can see here MACD is crossing over the signal line. So again, that's going to confirm that breakout there. So things are starting to turn around for the good for the DXY at this point in time. When you can see on the chart, 102 is where the first layer of resistance is likely to go and be found. And look, I'm not sure we're going to go and see that coming through after tonight's data, but certainly as we get into next week and some of those bigger data pieces come out, particularly around the labour market, if we see continued resilience in those particular releases, there's every chance we're going to see a further retracement of this move back to around that 102. That will be the first stop. And then you can see this former uptrend support is pretty important as well, and that's located just above. So keep a close eye on that zone if we see this move in the dollar continue over the next week or so. Probably explain a lot of the move, what's going on DXY. Let's have a look at the other biggest component in the narrow dollar index. Euro dollar, you can see here, bullish breakout, went on with it, back again, and then rebounded up. And this is the early parts of the week. It just was motoring higher. A lot of people getting excited, went and took out the highs that we saw back in late 2023. But the price action ever since has not been crash hot when it comes to euro. You can see here, bearish engulfing candle on Wednesday, followed up by more selling coming through. We saw those soft inflation reports from around the euro area. And again, it looks heavy. 110.45, first layer of support. Beneath that, 109.48. But you look at what's going on with RSI 14 at this point. It's broken in the uptrend. MACD has crossed over from above. So two signals there that momentum is certainly shifting away from being bullish to more bearish in nature. At this point, I'll be selling pops rather than buying dips in the euro. It just looks heavy on the charts, and we keep seeing those pricing coming through and increased pricing for the ECB. That's going to go and weigh on the common currency. Might as well have a quick look at the Japanese yen as well, which unlike the yuan is, it's still weakening against the US dollar. So it's continuing that move that we've seen after that big sell-off in dollar yen earlier this month. At this point in time, not a lot to go and speak of. Still in a downtrend when it comes to RSI. Nothing really doing when it comes to MACD, in my opinion, as well. It has generated a bullish signal, but two conflicting pictures here when it comes to momentum indicators. And a bit like what's going on there, the price action is just really not doing much at all. You can see here it's struggled to go and break above 145 over the course of this week. And that's predominantly because it's still very much interest rate driven, and there hasn't been a big recalibration in US interest rate expectations over the course of this week, despite some of the resilience that we've seen in the data out overnight. When it comes to bigger levels for dollar yen, I'd really be looking for on the downside at this point in time. 143.63. Whilst this resilience in the data keeps going, to me, that's where it's likely to be bought at. You can see here, dipped. It's been bought every time. So buy on dips play, and potentially bias to me in the near term looks to be higher rather than lower. Let's have a quick look at SPY, ASX 200 SPY, and I'll go to a weekly time frame here. Pretty resilient performance, I've got to say, considering where valuations are at the moment when it comes to, and look, I've showed this chart a couple of times, but just to go and make the point, we're seeing lots of really ominous topping patterns that have been around this area in the past for SPY. But right now, that's not taking place. It's actually still managing to go high. There's nothing really to write home about when it comes to volumes. It hasn't been heavy participation. You do have a bearish divergence as well on a longer term basis against price, but it has gone and broken that downtrend there. You've also seen MACD's crossed over. So there are signs that potentially this one could stick, and we still haven't seen the close this week, but we're on track for the highest closing weekly close on record. It's pretty obvious at the moment. 8121 is obviously the current record peak. Around about 8068, that's the first layer of resistance. And on the downside, you can see here, lots of dips below 770 have been bought, and then further down, there's been a really strong bid around about 7,500, but we're still a long way from that point at this stage. So SPY futures, despite looking very, very expensive on a valuation basis, particularly the financial sector, it's doing all right. Just really quickly, I want to go and show, hopefully we're going to let me go and do it, why potentially it's defying a lot of the bears out there when it comes to its valuations. Just want to go, let's hope that comes back. There we go. This is what the market looks like when it comes to in US dollar terms. And whilst still sitting in near enough of record highs, it hasn't moved anywhere near as much. So for an unhedged offshore investor, SPY, Australian equities don't screen anywhere near as expensive as what they do for us locals here in Australia. So that's maybe one reason as well that we're seeing Aussie equities remain very, very buoyant around these areas. Let's have a quick look at what's going on in US equities in the futures market. I'm actually going to zoom in a little bit to the daily on this one. E-minis. Pretty important. This is a former uptrend, broke through earlier this month when all the recession fears started, managed to go and ram back through, and then it's been looking pretty toppy. 566.525 has been where it's just been knocked back consistently over the course of recent sessions. And you can see here, it's trading above that former uptrend, but pretty important close today, you'd imagine. It's just sitting here at this level. So keep a close eye on that, and then below that, 5584.75 is where dips have been bought as well. So to me, it's a pretty important close, and we know that the impact that Nvidia had didn't really have spillover effects to go and drag the entire index down, but certainly when it comes to the broader Mag 7 names, the money that flowed out of Nvidia didn't just go to cyclical parts of the market, it went to those Mag 7 names as well. So to me, that's probably explains some of the resilience that we've seen, and the fact that it hasn't gone and broken down despite that bit of a splat for Nvidia's share price. Look, when it comes to the NASI 100 futures as well, yeah, again, we've had that solid rebound. It's a little bit more weighed down by what's been going on with Nvidia. Support 19,204 at this point in time. Bounced off that, and you can see again, in likelihood, haven't seen a move when it comes to RSI 14, still in a downtrend. Still, we've got bullish signals from MACD, so conflicting signals in this particular path. But 19,204 still looks like it's going to be an area where dips will be bought at this point. Below 18,725 is the level to be concentrating on. And you can see here, earlier this week, around about 16,700 is where the price has been knocked down. But realistically, 20,02675, the high that was struck on Thursday, August 22, is a level more important, in my opinion, to go and keep an eye on. Gold as well is one I thought I'd have a quick look at, because it's threatening to go and break to record highs as well. Just go and get this up. You can see here an uptrend, ascending triangle at the moment, squeezing up, tested it, bounced back through. And at this point in time, yeah, I don't mind gold. The one kind of area that I'm looking at, you can see on a MACD, it's threatening to go roll over a little bit. Also, we're seeing bearish divergence between RSI 14 and price, only very minor at that point. But realistically, we know that it comes down to interest rates and the US dollar. So they're the key drivers of the gold price here and now. So it depends on what happens in the near term, particularly next week around that payrolls report. But when you look at how far is gold going to pull back in an environment, well, I doubt it's not going to go too far. You can see here, 2483.76 is one area to go and keep an eye on. Again, 2470 is where it's acted as both support and resistance earlier this month. And at this stage, nothing really from price signals on the other daily candles that you can go and write home about. Yes, this bearish engulfing was there, and then it will snap right back up. So to me, it's been a quietish week when it comes to volumes. We've not had a lot of new information, so maybe explain some of the choppiness in the price action right now. Look, Miles, going to open it up to the floor for those who are listening, and thanks who have been holding around. I'm just going to put a disclaimer up, just reminding that anyone who participates in this particular segment is doing it at your own free will. Any advice that I give is general in nature and does not go and consider your own personal circumstances. Please feel free to go and send any questions through on the chat. And then I did receive one from Stephen earlier on today that I'll just go and have a look at. And I wanted to go have a look at the jobs data in the States in particular. So I've discussed what to keep an eye on when it comes to payrolls next Friday. But realistically, I want to go and have a quick look here at what's going on when it comes to some of the things that are maybe concerning about what's going on in the US labor market that's not being picked up by some of those other metrics at the moment, like jobless claims. Let me go and get to an appropriate time frame here, monthly. All right, so let me go move this up. Unemployment sits at 4.3%, which still, as you can see here, is very, very low by historic norms, going back all the way past 1950. However, you can see why Jerome Powell was feeling a little bit nervous and certainly was talking about didn't want to go and see any further weakening in the labor market, any softening coming through, because you can see here that it looks so similar to many other cycles. Now, excluding what happened back in the pandemic, which is just a one-off, you can't really go and justify that as something to go and benchmark to. But what you can see here is before the GFC, started to go and tick higher, and it's then really started to ramp. Again, bottoming around the tech wreck and September 11, and then again, really starting to go and push higher. And you can see just a litany of very, very similar moves that are taking place over the time. I mentioned the underutilization rate, so part-time workers, unemployed workers, but the part-time workers have a job, but they want to go and work more hours. They want a full-time job, but they can't get it. And it too is starting to go and show those signs of jackknifing higher. We don't have the same data set in terms of length, but you can see here, excluding the pandemic, again. So we saw that big increase in July. You see in price cycles, big increases, and all of a sudden it accelerates. So I can understand why Jerome Powell doesn't want to see any further weakening, because this is a lagging indicator, and if it's already happening, if we get further confirmation, more of those moves coming through in the August report, it's going to be the case that the Fed is going to cut pretty aggressively. And we go have a bit of a chat about that in just 2 seconds as well. One thing I also keep a close eye on is youth unemployment, the ability for the labour market to go and absorb new entrants into the workforce. And whilst it too still is very low at around about 9.1%, when you look at where it bottomed, that was back in around May of last year, and now it's up 2.5 percentage points. And that's a pretty big increase as well. So that's a sign that, again, slower economic growth is starting to go and make it difficult for younger Americans to go and find a job in the other labour force. Now, at the moment, the markets are sitting and talking about the Fed. Will they cut 25 or 50 in September, depending on what the other payrolls report is? I think it's really important as well just to go and remember that the Fed thinks the neutral rate, where policy doesn't either constrain or accelerate inflation or lead to a change in unemployment, sits at 2.6% right here. So you can see at the moment, we're about 280 basis points above that level. Now, I completely understand 25 and 50. That's how it comes across in terms of the outcomes. One thing's just really, really starting to go and make me question, if we were to go and see a further weakening in the jobs data, the unemployment rate ticks up again, 4.4, 4.5. We see U6, the underutilization rate, tick up even higher. Will the Fed be willing just to go and do a 50, knowing that policy rates are way, way, way still, in its opinion, in contractionary territory, restricted territory? And that's the tail risk. That's the left tail risk that you wouldn't be aware of. But in terms of if we get a really, really weak outcome in the payrolls report, it would not surprise me in the slightest to go and see the market start to go and get uppity about the potential for a 75 or something greater. It's a very, very small tail, and it's reliant on a lot of the data we've received so far in the labour market to be proven incorrect. But that's something to go and keep an eye on as well, because at this point, policy remains very restrictive at these levels. And if the Fed can see clear evidence that the labour market is starting to unravel pretty quickly, it needs to go and get that not only down to 2.6%, but conceivably even lower. And doing it in small increments, yes, it's going to go and cause some panic in markets, but the alternative would be to go and drag your feet and really lead to a pretty nasty sell down. I can't see any further questions coming through to the floor. I'll just go and wait for another 30 seconds or so. Please shoot them through if you've got them. Otherwise, we'll wrap up and you can start getting yourself prepped for what's going to be a massive, massive week in the next couple of days. Well, to me, I can't see any more coming through. So thank you so much for joining me, all those who attended. If you've got any questions, shoot them through to me, either on the link you can see in the YouTube, or alternatively, you can go and get me on X as well.